Your credit score is a very important number that will have a strong impact on your financial future. A good credit score allows you to get loans and credit easily and quickly, and you can even get favorable credit terms if your score is high enough. And on the other hand, a bad credit score can increase your cost of raising finances and also close the door on many opportunities in the lending market. In order to improve your credit score, you'll have to understand the factors that can increase or decrease your score. That way you can take action to keep your credit high. And in this video, I'll go over the ways that you can do that. Hey, what's going on? It's Chris here from Wealth Awesome. Your credit score is affected both positively and negatively by many different factors, and there's 5 major ones. So let's go over all of those. Stick around until after the list is finished, and I'll go over ways that you can monitor your credit score and get free credit score reports for free in Canada. If you get lost or want to learn more, check out the written article at wealthawesome.com. The first factor is to make on-time payments. Your history for clearing payments on time is crucial for a good score. It determines how responsible you are as a borrower and also informs creditors that you can settle debts on time. If you consistently pay off monthly dues such as mortgage payments, insurance payments, and credit card bills, your score will build up. Every time you miss a payment, your credit score drops a little. Serious payment delinquencies like bad debt write-offs, forced collections, or bankruptcies and repossessions of property can really damage your credit score. This is the highest weighted factor, so make sure you get your payments done on time. The second biggest factor is the capacity of your credit used, which is 30%. Your level of debt also affects your credit score. The more debt you have, the riskier you become as a borrower, and the higher the impact on your credit score. Credit rating agencies look at this one key factor. The debt to income ratio is one of these factors. The higher your monthly payments become compared to your income, the more it affects your score. So the higher your debt to income ratio, the worse your score will get. The amount of credit balance compared to the credit limit also affects the score. As a rule of thumb, you should maintain a credit card balance of less than 30% of your card limit. Once your credit card balance goes over 30% and stays there for a certain amount of time, your credit score will begin to get negatively affected. The FICO score, as I mentioned, is determined by 30% of the outstanding balance owed. The third ranking factor, which accounts for 10% of the score, is the type of credit that you have. There are 2 basic types of debt. First, there is revolving debt, like the one that you probably have on your credit cards. For this debt, you can take on credit based on your cash flow needs and pay interest each month. When you pay off an amount more than your month's interest, it reduces the outstanding balance. There's a minimum amount that must be paid for each period, but no fixed date for the repayment of the full credit. And that's how it gets its name, revolving credit. The second type of credit is installment based, where you're required to pay off the outstanding balance in monthly installments for a fixed period. Part of the payment goes towards interest, and the other part is used to repay the principal amount. The total amount that you are required to repay for the duration of the loan is fixed. The interest rate is generally higher for revolving credit than for fixed installment-based loans. Mortgage payments or your mobile carrier's monthly payments are good examples of installment-based credit. Credit debt that is used to buy assets like a home is considered good debt. Credit balances that are used to purchase items like groceries, clothing, and fashion accessories, on the other hand, are regarded as bad kinds of debt. Good debt has less of a negative impact on your credit score than the bad type of debt. The next major factor that impacts your credit score is new credit inquiries, and that accounts for roughly 10% of your score. Every time you try to get a new loan, your lender makes a check against your credit. This check becomes a permanent part of your card's history. 1 or 2 checks once in a while won't affect your score by much, but if you make 5 or 6 checks in a short time of around, say, 3 months or so, it can indicate that you might be facing some financial problems. Credit ranking agencies flag it as a negative, and your credit score can suffer, even if all your credit applications are approved. And what happens if your request for credit is declined? If that happens, and if the loan or credit is denied for any reason, your score drops almost immediately because you are deemed a high-risk borrower right away. There are some ways to work around this. For example, some lenders offer to make a check against your credit that would not appear on your credit history. In this case, your score is not affected even if the loan is declined or denied, and that's known as a soft credit check. The good news is that credit rating agencies only consider inquiries made within the last 12 months for credit score determination. Inquiries are completely removed from the credit report after about 24 months. The fifth major factor is the length of your credit history, which accounts for 15% of your score. The age of your credit history is also taken into account when figuring out your score. If you have a credit history for 10 years, your score is likely to be higher than it would if you had the same credit history, but it was only 1 year old. Having a long history of credit is considered better because it shows that you have some experience with managing credit and you are likely to do well with money in the future as well, and lenders are more willing to offer you credit based on this longer history. The age of your credit is determined in 3 different parts. Number 1, how long have you had the accounts? Number 2, how long has specific types of accounts been open? And number 3, the period that has passed since those accounts have been last used. When you open a new bank account, it affects your average age of credit history by reducing the age of your credit history. For example, suppose you have had a checking account for 5 years and you get a credit card for the first time today. Since your credit card account is completely new, your average age of credit history would be 2.5 years approximately. This is a simplified calculation and it gets more complex than that, but this is just a simple example to show you how this works. So here's a snapshot of FICO factors for determining your credit score. And the FICO factors are, as I mentioned, payment history at the highest, amounts owed, length of credit history, new credit, and your credit mix. How your credit score affects you. Your credit score can have a significant impact on your finances. Firstly, a low score reduces your chance of getting approved for loans, mortgages, insurance, and other type of credit. Number 2, a bad score can also increase the cost of your payments and bills. Number 3, when you're applying for a home or car insurance coverage, your insurance agent will make a check for your credit rating. If your score isn't high enough, your application can be denied. Number 4, your credit score can also affect and change the way you pay for things. A good score can get you approved for cards that have a high cashback rate, allowing you to shop on credit more often for discounts. And number 5, your credit score can even affect your employment. Financial institutions and banks often consider the credit score report of potential employees to check for any red flags of things like credit fraud and any type of deceit like that. They'll be a lot less likely to hire you. Here's some unexpected things that affect your credit score that you might not have thought of. Number 1 is the number of times you spent above your credit card limit can impact your credit score negatively. If you max out your credit card, it could cause a drop in your score. A maxed out credit card shows creditors that your usage is high and you take up more debt than you could pay off. To avoid this, keep your short-term balances below 30% of the card limit and ideally below 20% for longer time frames. The second factor that people don't realize is if your lender sends your debt to a third party for collection, it can cause a huge drop in your credit score. This can only happen after your creditor has given you plenty of notices and opportunities to pay off the balances. Mostly, you'll be able to work out a deal with your creditor as an installment plan to settle your debt. If the debt isn't settled even by the collection firm and the matter is resolved through the court, it could damage your credit score even further. And this could even be for small bills like $100 for a phone contract. This can negatively impact the way that you can receive lending in the future. The third pitfall to be aware of for credit scores is a credit default and write-off occurs after all avenues for debt collection has failed. And this becomes a permanent part of your credit history and remains on your books for years. Lenders are generally unwilling to extend credit to someone with a default history. Keeping your credit score high is important to get approved for new loans, insurance, and credit. A good credit score also reduces the interest charges that you pay, and the higher your score, the less risky you become to creditors, and the lesser your risk, the less interest you'll pay on outstanding balances. So it creates this almost snowball effect of good faith and lower payments if you have a good credit score. It's important to have a thorough financial understanding of how the credit score works and how your decisions affect it. A healthy mix of credit that includes revolving debt and installments is probably the way to go. So my thoughts on credit scores are, it's very important. A couple of bad mistakes can really mess up your credit score for several years in the future. And I've always found that the best way to improve on anything is to keep track of it closely and to monitor it as you make changes and adjustments to your habits. The best way I think to do this is by using Borrowell. It provides free credit reports for all Canadians and free credit monitoring as well. So it's a very easy platform to use and set up. And it's a great way to keep track of your credit score. I like to do mine at least on a quarterly or monthly even basis. Even if you have good credit, you should check your score for things like fraud or if anyone's trying to impersonate you on your account. I think it's very important to check your credit score. I like to do it very often. So check out the description below for a link to Borrowell and you can sign up there. Alright, so since you made this far, make sure you like and subscribe to the channel. I put out new content every week. Also be sure to check out the blog, wealthawesome.com. It goes into credit topics in way more detail as well as many other topics for Canadians, and it's one of the fastest growing resources for personal finance in Canada. I'll put a link in the description to that as well. And as always, thanks for listening.